Joining us today, Truist Managing Director Bill Chappell. Bill, the note got a ton of attention this morning. One thing you do add is that you're not sure investors are paying enough attention to what may be happening to the consumer after several quarters of price hikes.
Yeah, thanks for having me. Exactly. As we put in our note, you look over the past 6+ quarters for P&G, and they've beaten every quarter on the top and bottom line, which has been fantastic, and they're operating at a high level. But volumes have been down 6 out of the past 7 quarters, and we expect that to continue. And the belief we've heard from investors, from the press, from whatever, is P&G can continue to price the high-end consumer so strong. They can take that price, and we're not no problems ahead. But if volumes continue to decline, that's demand destruction. People are using less of the product or trading down to a different product. And at some point, you have to address that, or the consumers will never trade back up.
But what we hear from P&G is that consumers aren't trading down, that elasticity remains much better than in previous cycles, and they don't really see signs of weakness from the consumer. Are you saying that they're underplaying it?
I'm saying it's too early to make that call. I view this last quarter, which P&G and many consumer companies had great quarters and are continuing to raise prices, as a lagging indicator of that was similar to what we saw in 22. Not necessarily a leading indicator of what we're going to see for the remainder of the year. And you're seeing from commentary from Target, from Home Depot to others, that you're seeing some cracks. And understand, this is not a call of we're going in a recession. This is a call of people who are buying Crest with softening and whitening and sensitivity for $5. Maybe we're just going to take a couple of those things out and buy one for $4. And at some point, at some point after 12, 18 months, you're tired of paying $5 for toothpaste, and you will trade down.
Yeah, I don't know that you need sensitivity and whitening in one toothpaste, but I get your point. So, Bill, the other bullish argument that I hear on P&G is that this is a very different company than it was in previous cycles. It's a much more focused company, as you know. I mean, we were just talking about shrinking to grow. They got rid of a lot of the brands. They got super focused. They had Nelson Peltz on the board, and they've totally transformed the way they are. So going into this cycle, they're in a lot stronger shape.
Absolutely, and I wouldn't doubt that at all. I mean, it's amazing or remarkable what they've done in the past 5 years. This was the least loved consumer staple company 5 years ago. Before Mark Taylor came in, and now John Mueller came in and really kind of turned them around. They got out of 100 brands. They focused on cost cutting and superior products. It's running at the highest level, or the best level, in the 20 years I've covered the name. But at 27 times earnings, which is 4 to 5 multiple points higher than its 5-year, 10-year, 15-year, or 20-year average, at what point is that fully reflected in the stock price?
I guess the question is what you prefer. I mean, do you graduate to a KMB, or are there other less obvious examples?
No, I mean, I think it's the Coke, it's the beverages. I mean, you don't have to worry about trade down or a weakening consumer for beverages. They didn't take as much on pricing over the past 2 years as HBC names did. And so that's where I'd more lean. But you bring up another point. That's the other thing that's interesting right now on P&G is it's gotten a lift because of the banking crisis and the flight to safety. But in past cycles, P&G had a 4% dividend yield, and treasuries were 0.5%. It's a different flight to safety these days, and that's part of also a concern that this doesn't hold up as long.
On the flip side, aren't all the input costs going down? Commodities
and
Forex is working in their favor a little bit more.
Absolutely, and we expect, and I think everyone's modeling for meaningful gross margin expansion in the back half. And again, part of it is there's no surprise factor. They've beaten 6 straight quarters. People are already modeling hundreds of basis points of margin improvement next year. And so, and the key thing to understand with P&G is they don't hedge anything. They don't hedge currency. They don't hedge commodities. They're the only large cap staple name that I know that does that. So you're also banking that nothing goes wrong in the next 9 months, because if they do, it'll immediately affect those margins and that forecast. So it's a little bit different. I'm not hoping for anything to go wrong, but it seems like something goes wrong at least once a year, every year.